If you're here, you know about trend following or you want to learn about trend following. If you want to hear my opinion or anyone's opinion about what will happen tomorrow, about what the Fed will do, about what Trump will do, about what will happen to the bond market, the stock market, commodities markets, I don't know. You don't know, and no one knows. So with the disclaimer out of the way, let me reach back into the archives and give you two pieces of food for thought. Two academics who happen to like trend following. No delay today, jump right in, and I'll see you again next week. I have a sneaky suspicion that a lot of you are going to really like this particular conversation. My guest today is Campbell Harvey, Canadian economist known for his work on asset allocation with changing risk and risk premiums and emerging markets finance. He's a professor at Duke University as well as a research associate with the National Bureau of Economic Research in Massachusetts. For those of you that love the conversation of the bell curve and skew and risk and volatility, Campbell is extremely proficient at really good explanations. I hope you enjoyed this conversation with Campbell Harvey. So listen, let me break this apart with you. You've got this interesting paper that I've come to be aware of called Evaluating Trading Strategies. And I want to kind of unpack how that started. And before we get into the trading aspect of that, I wonder if you could use the example that goes into football first and just kind of like let the audience slowly come into this thinking.
Right. So there are plenty of sports examples here too. And maybe football is one of them, where like a team could have many wins in a row, or a quarterback many passes in a row. And the issue is that due to skill, or is it luck, or is it a combination? It's also the case that the quarterback could appear to do quite poorly in not making that many passes. That doesn't necessarily mean that the quarterback lacks skill. It could just be bad luck. Again, if you're evaluating in real time whether to poll the athlete or not, this needs to be taken into account. It is the same thing with investment managers, where you can outperform the market many, many years in a row. It's not clear that that's a result of skill or a result of just good luck. And it is a vexing problem in finance. How do we separate the skill from the luck?
Before we get into your paper and the example that you have in particular about a particular trading firm, their strategy, I was just thinking as you were talking about beating the market for many years in a row, I'm quite fond of him. He's like some of my work. I've had a chance to meet him several times. He had a fantastic run at Legg Mason, and that's Bill Miller. I think he beat the S&P for 14 years in a row, I believe. But then at the end of the 14-year stretch, there was a pretty significant drawdown in the 2008 crisis. So I think this, as you make this point about skill versus luck, there's no doubt it's not an easy subject, is it?
No, and look, it can be a combination. That's the thing. It's really interesting if you group the best performing hedge funds or mutual funds and then hold those for the next period and just keep on doing that. So you just buy the winners, like the extreme winners. You just have that as a strategy. Then what you find is that portfolio does poorly. Some of this is just luck, that the people at the very top probably were blessed with good luck. That doesn't mean that they're unskilled. They could still be skilled. Yeah. But they were skilled plus the luck that got them up there. And this is the way that I usually like to explain this. And Suppose that you just like grab a whole bunch of dice, like a large number, let's say 36 dice, and you drop them on the table. And then you go pick out all of the ones that show 6. And let's say there's about 7 of them, and take all the other dice away off the table. Then you drop the ones that all have 6. And you're going to get a combination of 1, 2, 3. It's going to average of about 3. And think of that as the people that did really well. The 6s are the people that were at the very top, that did the best. And then when you throw those dice again, it's just natural that you're not going to get 7 6s from those dice. So a lot of this has to do with regression to the mean and luck.
I was thinking of 2 very famed investors, traders. One very famous, one not so famous, but just as successful. Jim Simons at Renaissance Technologies. I mean, he's had math formulas named after him. He will come out loudly and clearly always say, hey, I'm a very lucky guy. Now, that's not, as you just say, that's not taking away from his skill. And I could think of the most famous USA investor, the wealthiest USA investor. He also says, he says, look, I won the ovarian lottery. I mean, that's Warren Buffett. So there's clearly a piece of luck at play. And I think as we start to talk about, as we start to move into your paper, the notion of survivorship bias really starts to become an interesting topic, because, if we are to look at particular trading strategies or particular traders, I always say to myself, and not in any way to take anything away from Warren Buffett, but there's not a lot of other Warren Buffetts.
That's true. And I think that Jim Simons, Warren Buffett are probably
they're up there.
they are up there, and they are saying, "Well, I was lucky." I really that's a hard one to believe. I know Jim Simons. I don't know Warren Buffett. They do very different things. From what I know of Simon's operations, there's a lot of skill there, but as you say, it can be a combination of having skill and good luck.
Well, you got to have a strategy. You got to have a strategy that's predicated. I'm thinking maybe for both of them, perhaps you have a strategy that puts you in a position to benefit, which I think is a skill to think this through, puts you in a position to benefit when the unexpected happens. If one has a strategy that can operate like that, that starts to be skill-like.
Yes, no, definitely. And again, it might not always work.
Sure, process versus outcome. You could have a great process, and it doesn't necessarily mean that outcomes could be beautiful every time, right?
That is correct. And you mentioned survivorship bias, that the people, the winners are the ones that survive. There is a kind of reverse type of bias, and that is that some very skilled investment managers drop out because they've had bad luck. That's kind of a reverse survivorship bias. But this is really important, that this idea doesn't just apply to investment managers. Just let me discuss just for a minute another research paper I have that does a psychometric survey of CEOs. What my paper finds is that CEOs are hugely more tolerant of risk than the lay population, like by a factor of 10. It's extraordinary. And you can think of a scenario where these people that are very tolerant of risk enter a firm as a junior employee. They take a lot of risk, and some of them they get lucky, it turns out. Others, they don't get lucky and they drop out of the firm. And then these people that are taking a lot of risk with enough luck will rise to the top and be the CEO. Whereas the person that's risk averse never takes that extra bit of risk, never experiences the good luck, and is stuck in the middle of the firm. So this explains why the CEOs happen to be very tolerant of risk. The interplay of that plus luck, I think, goes a long way to explain kind of the kind of psychometric qualities of CEOs.
I can think of two very famed investors, heads of investment banks, who I think until the fall of 2008 were just, for the vast population out there that understood what they did, they were viewed as Prince Charming. Nothing could go wrong. Maybe Ace Greenberg at Bear Stearns and Dick Fuld at Lehman Brothers. I mean, these were guys that I think would fit right into the outline that you were describing. But then on the backside of an entire career of taking more risk, waking up one day and the dice come up different, huh?
Yeah, exactly. And of course, risk is two-sided. So there's an upside and a downside. And this was obviously a negative realization. It's really hard because they were on a roll, so to speak. This could be bad luck, or it could be lack of skill.
As we were talking about the survivorship bias issue, and we're going to probably talk about that multiple times today, but I was thinking, you said, well, it could have been very successful investors, and then they drop out after a long, like the two I just mentioned, a long string of success, and then boom, they drop out because of. I sometimes think, though, that as another side of that coin, I often see that we'll talk about successful investors, and then we'll say, well, survivorship bias, they're the lucky ones left. What about all the other guys that failed? Or the implication being that everyone that failed was as skilled and had the same technique or same strategy as those winners, which I think sometimes that's not, I don't necessarily see that evidence all the time. I think sometimes we just assume they were equal, but they're not necessarily equal or taking the same steps or strategies. Just another facet of this, right?
Yeah, totally agree. And it could be a much different strategy. But like in the end, that's what they choose. So you could think of every investor having a slightly different strategy. Some of them might be chasing real risk premia. Some of them think that they're chasing real risk premia, but it turns out that it's not. Others are chasing mispricing in the market that might be fleeting. Indeed, it might turn the other way, that once you start buying, all of a sudden, instead of something being undervalued, it's overvalued. So there's just a myriad of different strategies out there, and some of them will turn out because they should turn out, like capturing a long-term risk premium, and some of them will turn out just by luck.
You're just excited in terms of your research. Was it random?
That's correct. So I think that we don't do a very good job at basically questioning the performance and basically saying, was this due to luck or was it due to skill on both sides? So this is very important. So we look at these investment manager stars and think that they've got a huge amount of skill, and we don't consider the other side. How much of that is luck? As I said, goes both ways, where and you know how often this happens, where you hire an investment manager. You look at the track record. It's a wonderful track record. You're comfortable with the track record. You invest with the manager, and then they have like 1 or 2 years of subpar performance, and then you fire them. And as soon as you fire them, the next year they do great. Well, what's the story there? Well, it's a simple story of just like I mentioned with the dice. You have a couple of years of bad luck. Indeed, in the track record, there's probably a couple of years like that too. But you tend to ignore that. You fire the person at exactly the wrong time and you pay the price. So investors just don't do a very good job of attempting to weigh the balance of luck and skill.
Okay, before we get into your paper, I want you to put your professor hat on for a moment. And I think one of the reasons that perhaps so many people get confused is that our thinking, we want to think in terms of this nice normal distribution because it works great for weights and heights and all this kind of stuff. And it's just fantastic. Everything's just normally distributed. But in the real world of asset management and trading and investing, there's something called skew. Why don't I let you run with it here for a few minutes as you're opening up to the class for the first time to try and unpack a little bit of this wrong thinking about the normal distribution and what skew is exactly.
Sure. And this is an important component of my own research. There's a path-breaking paper published in 1952 by Harry Markowitz on how to kind of optimize a portfolio. That paper led to a Nobel Prize for him in 1990. And basically what this paper does is it says, well, what we want is a portfolio with the best possible target return, but the lowest volatility for that level of target return. Essentially, this is the optimal trade-off of expected return and risk. And I'd like to put risk in quotations because in this path-breaking paper, there's a footnote that's buried at the end of the paper that basically says, this only is appropriate if the asset returns are normal and investors have no preference for skew. So let me explain what that actually means. If the asset returns are so-called normally distributed, then there's no unusual tail behavior. That means that there's no severe downside, there's no severe upside. The upside and the downside are exactly symmetric. The usual measure of volatility, that's exactly what happens. That, for example, you could have a stock that is going up dramatically. Maybe it goes up like 300, 400%, and it's got a high level of volatility. And you can have another stock that goes down dramatically, maybe goes down 95%, and it's got the exact same level of volatility. Volatility doesn't tell you anything about the direction. It's measuring the surprises in an absolute sense. So volatility is symmetric. It treats the upside and the downside the same. Skew, on the other hand, tells us the balance between the upside and the downside. So you could have two portfolios that have the same target return, that have the same volatility, but they've got a different skew. So one has got an abnormally high probability of a severe downside. The other has got an abnormally high probability of severe upside. So for any investor, it's obvious which one to choose. You choose the one that has got more upside than downside. I've been on a campaign for many years to try to change the way that we think of risk, change the way that we actually do asset management or portfolio management, to take this asymmetry between the upside and the downside, to recognize that it is rare that any asset return is so-called normally distributed, and actually make that part of the portfolio management exercise, and equally as important, make it part of the risk management exercise. I am tired about hearing about these 20 standard deviation events, like what happened to the Swiss franc, or and there's many other during the financial crisis, the Russian crisis, all this stuff. 20 standard deviation events. It's not 20 standard deviations. It's only 20 if you believe naively that these asset returns are normally distributed. They're not. So don't even tell me this. It doesn't make any sense.
I've had Harry on my show. I had a chance to meet him before. He's a really neat guy. He's still sharp as a tack. I think he would make the argument, and I think he has, that like, okay, I did my paper, and this was, I don't want to use the word exercise, but that's what's coming to my mind right now. I think he was surprised at how the industry took his work and he really wasn't a part of what happened, but they kind of took his work and ran with it. And that was essentially how modern finance got built off the back of his work, isn't it? That's a fair brief synopsis, isn't it?
Yeah, no, I was at a conference with him 3 weeks ago. It is that 1952 paper is an amazing paper. I've only mentioned one thing that he foresaw. There's another important one also. Yeah, I think that this was like a simple framework that he proposed. It works under special assumptions. He was the one that recognized what those assumptions were, but then you're right. The industry just goes with something and doesn't think about like when is it appropriate to apply and when isn't it. When I teach finance at Duke University, it's one of the main lessons for my students is, okay, we've got these models. All these models are wrong. That's why they're called a model. You're simplifying reality. And the issue of applying your skill is knowing when to apply a simplified framework and when not to. In certain situations, it's fine. Other situations, no. So I think that Harry is really the father of modern finance, and that paper is just an incredible piece of work, given that he saw not just the usefulness of his simplified framework, but he saw basically how to take it to the next level and to incorporate this idea of skew.
Let's jump into, as I mentioned at the beginning of this episode, your paper, Evaluating Trading Strategies. And it did catch my eye for one thing in particular, which is your early example. And I want you to explain how you selected this. And I want to make sure that, I assume that I knew the advisor that you were talking about, which was AHL, which is a managed futures trading operation owned by Mann out of London. That was the example, right?
Yeah. So let me describe the example, and it's from a seminar at Mann AHL, who, as you say, is a managed futures house that manages about $15 billion. So at AHL, they look at strategies all the time. They think very deeply about this luck versus skill. This is a strategy that basically they showed a cumulative profit from 2004 through 2014. It's a graph, and it's basically going straight up. It's extraordinary strategy where it's got 1 year that has a very small negative return in 2004. It knocks the ball out of the park during the financial crisis. It's got about a 15% annualized return, 15% volatility, so a so-called Sharpe ratio of 1, extremely consistent. We're looking at this strategy, and you can see people's head nodding. Yes, this is the sort of thing we want to put some capital on. And then the very next slide is really surprising. It adds to this graph the other 199 purely random strategies. So all of a sudden, this graph that was just one line going straight up is added 199 things that basically are centered around zero. The exercise was to simulate 200 random strategies with a target return of 0. So every single one has no skill. It's purely generated numbers and a 15% volatility. And you see the very top one, the very best one, is the one that was shown first. And then you see at the bottom, there's like a terrible one that earns 15% negative, and everything in between. And the idea is that just by pure random chance, and that's what the random number generator is doing, by random chance, you're going to see strategies that look great. You need to be very careful in a company. If you're doing internal research, what you don't want is your researchers sifting through hundreds of strategies and just picking off the top one. because when you put money on that top one in real time, it's going to do poorly.
And this was AHL presenting this information. You were at an event.
Yeah, because again, they're leading edge in terms of thinking about luck versus skill, and this was part of an exercise on how to avoid overfitting of back tests. So that's why that exhibit is there, because it is a great example that you could easily be fooled by random strategies.
What is your perspective, just as a kind of little interjection here, what is your perspective, your thoughts about the work of Nassim Taleb, the black swan thinking?
Oh, well, it fits in really well with my work on skewness. He talks about so-called black swan events. And again, these events that are like negative 20 standard deviation events, it doesn't make any sense unless it's a normal distribution. Because within a normal distribution, the probability of something like that happening is like one event in the life of the universe, which doesn't make any sense. So he's talking about these things that are basically not, you don't necessarily see them in historical data, but then they happen. A so-called negative, you could think of it as an extreme negative skew type of event. So that works in really well because his view of the world, as my view of the world, is that it's not symmetrically distributed. It's not normally distributed. So I think that that's important.
Coming back to the point you were making a second ago, though, I think when you have researchers, you have someone massive, I use a third party example, a TradeStation software, and people start inventing strategies. Most of the top traders that I've talked to, and I was looking at AHL, I've had a chance to talk to the H and the L in AHL. But I was thinking that you really need to have an economic thought process as to why this particular strategy might work. So, for example, if we were talking managed futures, we've been talking skew. Many of the managed futures trading strategies obviously are trend following in nature, and they're predicated on not really knowing what's going to happen next. A lot of their risk premia comes from hedging. I mean, other hedgers out there. I mean, people can make arguments about where their source of profits come from. But I mean, there's a thinking, a long-standing thinking that goes behind this particular strategy. And I think you're making the point that, hey, if you just sit down at your computer and you really have not even philosophically thought through what the strategy is, and then you only want to trust some random systems that come up and there's really not a thought process behind those systems, you can wake up in some trouble. Even if initially all your investors are sold on the idea of 15% returns and 15% volatility, and that sounds great, and you raise $1 billion. But if there's not a sound economic thinking behind what the strategy is, we all know what's going to happen.
That's correct. So this is the way that it should work. And I do know from direct experience, this is the way that it does work at a firm like Man AHL. And maybe it's no surprise that they've done so well with this. So basically, a researcher would come up with an idea, but without looking at the data. So they come up with an economic framework. And then they actually pitch that framework in a seminar. I'll call it that. It's like an academic seminar. They will get feedback, and then the senior people will actually decide whether the economic idea makes enough sense that you actually go to the data. Let's say it does make sense, then the firm will give the researcher what's known as a random partition of the history of the data. So they will give bits and pieces of the history to the researcher. The researcher will then test the economic idea, and this is the so-called in-sample testing. And then there'll be another seminar. The results will be presented of this exercise, and then a decision will be made whether to give the rest of the data to test it in the so-called out of sample. So it might be killed, or it might go ahead to the out of sample. So let's say it actually goes to the out of sample, and let's say it does well. Then there's a further stage where it will be invested in, but only invested with internal money. So it's multiple stages that you actually have to go through until that gets to client, because you really don't want to put anything to client trading that might be a result of luck, because you don't want to disappoint your clients. All the incentives are running the right direction to do the best possible thing for your client.
I want to go into a couple other issues as we wind down. I was giving a presentation in Singapore this spring, and I was speaking about the managed futures trading strategy of trend following. And at the end of the presentation, this young lady raised her hand, and she just had this look that said she probably had been at Duke in one of your classes and really, really was bright. You know, she just had that look that said, oh man, I'm in trouble. She's going to kill me. She's going to obliterate me. I'm dead. And she raises her hand, and she immediately shot herself in the foot. And I want you to kind of explain why. But she immediately was like, okay, can you tell me about the Sharpe ratio of these strategies? And I wanted to do a Vulcan mind meld and just say, hold on, let's don't just immediately assume the Sharpe ratio is the be all end all. Let's at least pick apart the pros and cons of the Sharpe ratio. But you could just see the indoctrination as she asked the question.
Yeah, incredibly naive, but this is the way it is in industry, and like on both sides, buy side, sell side, that people will look at an investment, look at the Sharpe ratio, which is the expected excess return, usually over some benchmark, divided by the volatility. So they are only considering the volatility risk. And let me tell you the type of trouble that gets you into. If you do like the Sharpe ratios of different investment styles, or maybe even like hedge fund returns, you'll see a wide variation in the average Sharpe ratios. You'll see gigantic Sharpe ratios for things like convertible arbitrage, but more modest Sharpe ratios for things like managed futures. And the reason is very clear once you expand the way you think about risk. Managed futures has got positive skew. And it's almost by construction, because when things are going up, you're buying. That's the same as replicating a long call option. When things are going down, you're selling. That's like replicating a long put option. So effectively, you can think of managed futures as something with a long straddle like performance, which has got positive skew. So they do really well in market meltdowns, and they do well when the market's going up sharply. So that is something that is rewarded by investors. They actually like that. It provides a hedge. Whereas these other Sharpe ratio, very high Sharpe ratio strategies, they can have severe negative skew. So for them, you need to have some extra return on average, because investors really don't like that severe downside. So you cannot compare two strategies based upon a Sharpe ratio if they have different skew properties. The Sharpe ratio does not take that into account. Indeed, it's very similar to what we were talking about earlier with the simple Markowitz framework, where you look at expected target return divided by volatility. Volatility is not a sufficient metric for risk. It is part of the story. It's not the entire story. If you make the mistake of just looking at volatility, then it's going to lead to a portfolio that will disappoint you.
You know, I was thinking back to that example I just mentioned with the young lady, and the moment I started to try to unpack the conversation, the Sharpe ratio, and talking about upside volatility, the blinders went on. It was just like, don't say anything else. I didn't know if it was I didn't want to listen, or I don't understand, or I've already got my mind made up. It was just, the indoctrination just strikes me.
Well, it's complicated, because this sort of discussion is not even in the textbooks. in finance. It's kind of surprising. So you can go through a top program.
That is a truest statement. Anyone listening right now that doubts you, I want them to go find where you're wrong.
Yeah, it's one of the reasons I don't use a textbook for what I teach. I teach out of my own notes and my own research articles. But this is something that you have to point a lot of fingers here, including pointing fingers at my own colleagues. So I just don't think that we do a good job of explaining risk to our students. I think in my classes, about 3 classes, we just sit down and just think about what risk actually is.
And that's such a great, you're making an absolutely fantastic point there. And I'm thinking this as we're talking, it's the put aside all the jargon and to get people to conceptually wrap their arms around the idea of what skew is. And even getting rid of the word skew, so to speak, and getting people to sit down and look at it all and really just, I think a freshman in high school with no math training, if properly explained what's going on, could understand this.
Yeah, no, I agree. Let me give the other insight
Sure.
in Markowitz's article that is relevant for this discussion. And that is that his framework assumes that you exactly know all of the inputs. You exactly know the volatilities. You exactly know correlations between assets, and you exactly know the target return. Exactly. There's no uncertainty in any of the inputs. Whereas in the practice of management, there is uncertainty. So another dimension of risk is that you think the correlation is, let's say, 0.5, but you're not sure. Maybe it's 0.2, maybe it's 0.7, but it's certainly not exactly 0.5. The same for the volatility. You think it's 15, but you're uncertain. Maybe it's 12, maybe it's 17. This is another dimension of risk. So most people think, well, risk is just the volatility. Well, another way of thinking about risk is, well, what if you don't know what the volatility is? Well, even deeper, what if you don't know the distribution? So it's not normal. We kind of know that, but what is it? So, or the skew. We don't know what that downside tail actually is. We can maybe estimate it, but we're not sure. All of this is risk, and it's rarely taken into account at this level, that there's a difference between risk and uncertainty. People usually group those together, and it shows that they really haven't thought it through.
You know, I think one last point to kind of end on as we talk about the notion of estimates and so many of the decision makers out there that are in charge of institutional money or making allocations. I mean, it'd be a long story to get to the point as to why many of them have maybe a faulty foundation. But the fact that so many decision makers that are in charge of other people's money think that somehow or another there is a perfect prediction for tomorrow, and that estimates are a bad thing when estimates are basically all we got. It's really crazy as you know what, that we've got to a position where there's so many people that think the world of investment management is supposed to be perfection. It's just an insane notion that we've got ourselves to this day and age.
And unfortunately, the actual investors kind of reinforce this because they will judge the manager based upon the past quarter or the past year. And that leads to a different type of behavior on the part of the manager. I would much prefer, as I said earlier, take a look at the track record. You're comfortable with it, fine. And what I actually recommend that investors do, and the investment managers, is to educate the client as to what could happen. So one way of doing that is really simple. Let's say I've got a 20-year track record. What I can do is to create, with the real data from those 20 years, an alternative history by kind of randomly sampling years and put them together. And then just keep on doing that. Then it gives you a way to look at what things could look like given the track record. So then when it actually happens, maybe you've got 2 years in a row of substandard performance, you can look at the history and say, well, gee, that's not unusual. That happens 25% of the time, given the track record. So if you believe the actual track record and you actually analyze it in this way of creating alternative histories, then it really helps you avoid the mistake of firing a skilled manager, basically because they've had some bad luck.
If I see 1% a month, every year, I'm either thinking it's Bernie Madoff Jr. or another long-term capital management. You just can't make money every month. I mean, maybe there's somebody with a high-frequency shop that's got some insane advantage that no one else has, but it just doesn't work that way.
Yeah, this is a great example of actually one of my exam questions was almost exactly this. So you've got somebody that is basically an S&P 500 portfolio, but on top of the S&P 500, they're writing out of the money put options and out of the money call options. If there's not that much volatility, you're collecting a premium. Month after month, given that premium that you're collecting, they beat the market. 1% here, 2%, 1%, 2%. It just keeps on going. It's a legitimate strategy. It is foolish to think that that is beating the market or alpha or whatever you want to call it. That's called taking risk, because if the market goes severely down, then you've got these put options you have to pay off. It magnifies the downside of holding the S&P 500. And on top of that, it cuts off the upside, because if the market goes up substantially, you need to pay out for the call options. So all that does is to take a portfolio, the S&P 500, and tilt it towards negative skew. And that's the reason that you see a return pattern like this, that people are getting a little extra return because at some point there's going to be a severe downside. So I think that is important to take into account.
It's cliche, but that free lunch thing really isn't so free. So, hey, Campbell, listen, I appreciate you coming on today, and I hope you enjoyed the time. I really think people are going to like this episode. You are a pro's pro in terms of interviewees, so I appreciate you coming on. Where can we send people to check you out, more of your work? Where's the best place for them to go? I know you got a Wikipedia page up, which probably leads to everything, but you fire out the URL.
You could go at Cam Harvey on Twitter. That would, and my blog is called Garden of Econ altogether.
Lasse Petersen is a finance professor at Copenhagen Business School and NYU Stern School of Business. He is also a principal at AQR Capital Management. His new book is titled Efficiently Inefficient. That's what we break apart today. I hope you enjoy this conversation. Efficiently Inefficient, the title of your new work from the last few months. I think obviously you're breaking some, I guess you could say it's some new ground, but obviously we've all seen in the last year or 2 years where the Nobel Prize was split between Fama and Schiller. I'm guessing that there was a certain inspiration for your title from that. If not, tell me the inspiration.
Yeah, that's right. So there's been this long academic debate about whether markets are efficient. In Gene Farmer, he stands for this view that markets are fully efficient and prices reflect the fundamental value of securities, versus prices are inefficient. And Schiller, he sort of represents the opposite point of view, that market prices are irrational. They're driven by investor irrationality, and investors push prices far away from their fundamental values. I have a great respect for both Farmer and Schiller. I know them both well. But I wanted to sort of take a different point of view, one that is somewhere in between, but also tries to be well defined, saying that market prices are neither fully efficient nor completely inefficient, but they are inefficient enough that smart asset managers and active investors have a chance to beat the market and be compensated for all the costs they have associated with actually becoming informed about asset prices and trading. At the same time, market prices are efficient enough that the marginal investor is sort of indifferent about pursuing this active investing, with the benefits being, better performance, but the cost being transactions costs, asset management fees, and the costs associated with finding a good asset manager. So there's just that equilibrium in which markets are just the right place in the between. They're just efficiently inefficient.
For the audience, so they know a little bit about this, your new work, Efficiently Inefficient, you do profile and you have a kind of a Q&A session with some very prominent names. And I want to quickly rattle those off, from Lee Ainsley, Jim Chanos, Cliff Asness, George Soros, David Harding, Myron Scholes, Ken Griffith, John Paulson. Obviously, some of the biggest names out there, and all very different styles. And we don't even have enough time today to break apart all those different styles. I'm going to kind of pick a few with the distinction that you're drawing, that you just described. How did these great traders, these great managers with such different styles, and I'm thinking in particular in this work, George Soros and David Harding are pretty dogmatic about, hey, the efficient market hypothesis is fill in the blank, bad word. So I'm curious, when you would explain your perspective, how did the managers and traders feel about your perspective?
Yeah, that's a great question. So definitely you're right that many of these managers, they would certainly not feel that markets are fully efficient. They feel very strongly that their job is to beat the market, and they succeed in that job, not because they're just lucky, but because markets are not efficient. You're right. David Harding spoke particularly strongly against the efficient market hypothesis. I think a lot of these guys at the same time, though, are sympathetic to this view that, yes, there is a scope to have edge, but very efficient to exploit these market inefficiencies. That's sort of another interpretation of the title. And I think they're actually quite sympathetic to this view. They don't think that just anybody off the street can easily beat the market. You have to be really efficient to actually accomplish that.
Were you familiar with and had met with and spoken with many of these managers and traders? Of course, some of them clearly very well. The full suite of them, were you intimately familiar in terms of having conversations, or was a lot of the interviews brand new with these particular managers? Obviously, their styles and what they do, but I'm just curious about your connection with them.
Yeah, you're right. I certainly knew of all of them. They're all extremely famous, as you say. I knew some of them well. I knew Cliff Asness. He's my colleague at AQR Capital Management, so he was the one by far I knew the best. I knew Myron Scholes quite well through my meeting him at academic conferences and in other connections. I also knew John Paulson. He endowed a chair at NYU, and I was lucky enough to actually hold the John Paulson chair. I was a John Paulson professor at NYU. So I met him in that connection. And I think several of the others I have never met. And so it's really exciting and fun to meet these guys and get their perspective on how they invest, and really try to get an opportunity to ask them exactly how they do it, and how do they get their edge, and what motivates them, and what are the key drivers of their success.
Was there a common theme developing in how they thought, regardless of style and technique? Just a very big picture question before we dive in.
Obviously they're all very smart. They're all extremely driven and ambitious. I think they're all disciplined and clear thinkers. In terms of their investment styles and methods, they're very different, but I think there are some common themes. Even though, they use very different words, I think a lot of them are using trading strategies related to value investing and momentum trading. So Cliff Asness, of course, has actually written academic papers and was one of the discoverers of momentum trading in stocks, together with a few other academics. And so he talks a lot about value momentum, but, a guy like George Soros, he will talk in very different terms. He will talk about trading on boom-bust cycles, for instance. But when he says he's riding the boom, in some sense he's being a momentum trader. And when he positions himself for the bust, at that point he effectively becomes a value investor. When you think about Lee Ainsley, who's a famous Tiger Cub, has done very well trading stocks globally. Obviously value investing and thinking about the quality of those companies is a key driver. Value is also, a key driver for a short sale like James Chanos, who basically thinks about, which companies are overvalued, which companies might be fraudulent or have some a little bit too creative accounting and so on. He wants to short those. And in shorting overvalued firms, he's basically taking the short side of being a value investor.
You bring up a great point about terminology and jargon. I can think to the classic phrase that Soros uses, reflexivity. I'm sure, it's a term that's been out there. There's a certain philosophical bent to it. He's written several books. But I think a great place where you can take apart some of the jargon and perhaps with your best professorial hat is the different types of momentum. And AQR is obviously known for both types, frankly, and quite a bit of not only the trading, but academic work. Why don't you, for the audience, give people, you mentioned Cliff and the type of momentum that he discovered, but time series momentum, the type of momentum that might be more commonly called trend following. Can you compare and contrast those two types of momentum for the audience?
What's called momentum in stock trading, often it's also called cross-sectional momentum, basically means looking at the different stocks out there and seeing which stocks have outperformed other stocks. And then you will tend to go long the stocks that have been outperforming, while at the same time shorting stocks that have been underperforming. And then you're basically hoping that those outperforming stocks over the last, let's say, 6 to 12 months will continue to outperform over the next month. So that is to be compared with what's called time series momentum, which basically means looking typically at an index, whether it's a stock index or a currency or commodity, and basically seeing if it's been going up in value, it's been trending up over the last year, let's say. So time series momentum is related to looking at every security seen in isolation, whereas cross-sectional momentum is looking at relative outperformance. And the difference is, for instance, if let's say the whole stock market has been going down, and a cross-sectional momentum investor, he might go long stocks that have been dropping less in value. So it might be, let's suppose all the stocks in a given universe have been actually going down. Some of them have been going down less, so those are outperforming. A cross-sectional momentum investor would buy those and short those that drop by more. Whereas a time series momentum investor or managed futures type of investor, he would just short all of them. He would say, they're all trending down, let me short all of them.
Going back to something you said as well, too, you mentioned the idea that some aspects of the technique of these very diverse traders and managers, that there's commonalities. I think one of the commonalities that I would love you to talk about is gambler's ruin, risk ruin.
Yeah, they're certainly all quite aware of risk management, and several of them actually was also told me about some of their losing trades. I think a lot of them are obviously very happy about the winning trades, but they're also quite marked and have learned a lot from their losing trades. It's really important that you learn from your losing trade, but also that you don't go bankrupt from your losing trades.
Are there any losing trades in a particular trader or manager that come to mind right off the top of your head?
Yes, so Lee Ainsley talks about one particular losing trade where he had like a great investment thesis. His analysis was correct, but it turned out the management that were supposed to deliver on those great promises for that particular company was not capable of doing it. And he really learned the importance of the management and has since really paid very close attention to the management of the companies he invests in. And, also Chanos talks about a short position he had that kept moving against him for a variety of reasons. Fortunately for him, he has a position limit, so as the short position moves against him, it gets bigger. And so this is one of the risks of short selling. When you're short selling, you lose when the stock price goes up. when the stock price goes up, if you have a fixed number of shares, now you're actually short more dollars or, a bigger value, and the risk potentially increases. So therefore, he has a position limit, and he would actually reduce his position as the position moved against him. And that helped him to limit the losses in that particular trade.
Most people out there, if they're familiar with Julian Robertson and the Tiger Cubs story, generally a fundamental style of thinking and trading. I thought was interesting was your questioning to Lee Ainsley about his quantitative aspects of his trading methodology, particularly portfolio construction.
Yeah, that's right. So he has a number of investment professionals who go out and meet with management and meet with the different competitors and try to really understand the industry where each company operates. But at the same time, he told me about the fact that they actually have a quantitative system to evaluate their positions, the risk exposures, and to really help them make the portfolio construction as efficient as possible.
Looking at all these managers, looking at these traders, their track records, studying their performance, is there a strategy? I don't want to ask the silly question, is there a best strategy? There are different strategies for different reasons. But is there a strategy, do you think, across these managers, these traders, that's perhaps more repeatable? There's only one George Soros, there's only one Paulson. What about survivorship bias? Do you see a particular style across this selection of traders that's more repeatable?
Well, I think what's common among these strategies is that they're not just this magic effort by this genius, but I think that we can actually understand the core of many of these strategies. There is an economic logic behind why they work, but at the same time, they require tremendous skill and dedication and hard work to execute them well. I think in my book, I tried for each of these styles and strategies. So I talk about equity strategies, macro strategies, arbitrage strategies. And for each of these, I try to understand what is the basic economics behind why they work and how you could create a repeatable process that could deliver potentially outperformance. It certainly has to be very difficult to do because otherwise these things would be arbitraged away.
Were you looking, when you were putting this book together, were you looking for the particular styles or were you looking for the particular manager and trader?
I started with actually thinking about what are the various classic styles. And then for each of these 8 styles that I identified, I sought to basically get the most prominent current investor who's still active. And so I wrote down these 8 names and I thought, how am I going to get them to say yes? And so I started with the people I knew the best. And then when those guys said yes, I had a connection to someone who knew George Soros. So then Soros said yes. And then when I started asking the next people, it started getting easier when you have Paulson, Asness, Soros, and the like.
Yeah, it's true. I mean, there's a certain, to put that together, anyone that does something like that as someone who's written a few books and does a podcast, there's a certain method to the madness, so to speak, to put together that roster. Something that Cliff brings up that you have as a question, and you're talking about the difference between the real world and the academic world. I like his answer because, we can go back at a performance track record, for example, and you can look and say, well, there was a 3-year flat period or there was a significant drawdown, but then you came out of it and everything was okay. Cliff points out that it's in the real world, it's not so easy to just look at track records like that, is it?
That's right. He talks about when you're actually going through such a tough period, there's a time dilation, he calls it, where it seems like time is going much more slowly and it's really painful actually to have those losses, even if you have greater gains coming out of it. It's really just an extremely tough period. And I think that's part of the reason these strategies work, in that it certainly is hard work to do it, but it's also really stressful and it requires a lot of discipline to just continue to do the right thing. When you're starting to face losses, there's a lot of temptation to panic or, do various things that are not part of the original plan because you think those losses might, be too difficult to handle otherwise.
It's interesting too. A lot of the traders and managers that you put in this book, I mean, that's one of the things they have to deal with is on a daily basis or a monthly basis, whatever, dealing with clients and kind of making sure clients are on board with the strategy and understanding that there could be down periods, et cetera. I'd like to bring something up that I talked about in advance with you, which is Warren Buffett. A lot of people don't know that Warren Buffett has had multiple 50% drawdowns, so to speak. I don't know the exact number, but there's something to that if you're going to produce the type of performance that he's produced over the years, you do have to be willing to take and handle a significant down period. But why don't you talk about Buffett and his alpha? I think you really put together some significant insights where a lot of people say, well, hey, hold on. If Buffett's just a value investor, why is he so much better than everyone else? You've kind of broken down and taken apart why he is so much better.
Yeah, that's right. So we got the data on Buffett's performance. We looked at both the performance in the sense of just the Berkshire Hathaway stock. So as you know, Warren Buffett is running the firm Berkshire Hathaway. And so one way to look at his performance is to just follow that stock price. But you could also see the publicly traded stocks that he holds. So Berkshire Hathaway has to make a filing to the SEC about the publicly traded stocks that they own, so we can put together that portfolio and simulate that portfolio at the same time. And the first thing we looked at is just how good is Warren Buffett? How good do you need to be to become one of the richest people in the world? And it turns out his Sharpe ratio is about just over 0.7, between 0.7 and 0.8, which I think actually surprised a lot of people when we showed them this number, because a lot of people had assumed that he had a Sharpe ratio above 1 or even above 2, as a lot of hedge funds are bragging about numbers in that range. It turns out he has had tremendously high return, but he has also had quite significant risk, leaving him with the Sharpe ratio, which is still incredibly impressive because it's about double the Sharpe ratio of the market. So for the risk he's taken, which has been substantial, he's actually, or over the long haul, been able to deliver double the return relative to that of the market. So it's really an astonishing performance. And our research doesn't in any way try to diminish that incredible accomplishment. But so when other researchers have looked at it, they have recognized he's a value investor. He talks about being a value investor. And so you can also regress his return on the return to being a value investor, which is called the value factor. And that factor explains some of his performance, but only a small part, and it leaves a huge alpha, that's sort of a big unexplained part. What we then did is to say, well, let's also regress him on the return to being what we call a quality investor. So what he buys is not just cheap stocks, but he also buys high quality stocks. And he talks about that in his speeches and his writings, that he really likes to buy high quality goods and high quality companies at a reasonable price. When we actually regress him on both sort of the standard factor, including the value factor, as well as this what we call quality minus junk, and also a factor that captures sort of more safe stocks, what we call betting against beta, then it turns out we can actually explain a large part of his performance and basically get a strategy that looks very much like his performance and has an ability to explain almost all his alpha. What we interpret that to be is basically what he is doing, what he's saying he's doing. Yes, he's a value investor, he's a quality investor. He likes to buy stable, profitable, high quality companies at a reasonable price. And those types of stocks have done well in general. The interesting finding is it's not just the quality firms that he has been buying that have done well, have been good investments. It's quality firms in general. And so those types of stocks in general have performed well. And he has benefited from being a very early investor to recognize that and exploit it. And he's been able to leverage it through his insurance company in a very clever and very smart way, and really performed extremely well as a result of those investment choices and that leverage strategy.
Yeah, you mentioned leverage. He definitely is using leverage to a degree that perhaps the novice investor might not understand, but obviously he's doing it in a very smart way. But he's not a trader devoid of leverage.
Yeah, that's right. He speaks quite negatively about leverage often, and certainly there are risks to leverage. If you look at his his portfolio and his performance, you can see that he uses leverage in two ways. Number one is that you can simply look at his balance sheet and you can see that he has leverage. He has a number of liabilities. He's been issuing bonds, for instance, as one source of leverage, and he has a lot of insurance-related liabilities. And we estimate his leverage is about 1.6 to 1, meaning that, for every dollar of equity capital, he will then invest in $1.6 of companies. Another way to see that he's using leverage is, you remember I mentioned that we could simulate the performance of his portfolio of publicly traded stocks. We could look at the volatility, the risk of that strategy, and then we can look at the risk or the volatility of Berkshire Hathaway stock. Turns out the volatility of Berkshire Hathaway stock is bigger than the volatility of his publicly traded stocks. That certainly is consistent with the idea that the Berkshire applies leverage to the portfolio. So if you add leverage to a portfolio, then you will tend to increase the risk. And so that sort of ranking of the risk is consistent with leverage.
It's just a tool, and he's using the tool wisely.
That's right.
Yep. I want to go into this notion of back testing, but I first want to start with a quote from Cliff Asness. Quote, "I think that good quant investment managers can really be thought of as financial economists who have codified their beliefs into a repeatable process. They are distinguished by diversification, sticking to their process with discipline, and the ability to engineer portfolio characteristics." For those traders out there today that call themselves more fundamentally driven or value, is there anybody that's not back testing their world in 2015?
Yeah, I think there's a lot of discretionary traders that will look at a unique special situation that you might have a very hard time back testing there. So if you're an event-driven trader and there's a new type of event, perhaps you can back test that, but perhaps you can still convince yourself that you're buying something at a discount to its fundamental value. You're relying on the general principle that sort of buying things cheap has worked over the long term. You might not be able to backtest in a more scientific way this type of strategy if you're trading a new type of securities and so on. So I think actually probably still the majority of investing is done in a more discretionary manner.
Do you think, though, that guys like Harding, guys like Asness, with this mindset of testing and this quantitative mindset, is it slowly making a dent in the consciousness where perhaps investors in the future are going to say, you know what, we want more than the discretionary ability. We want to really understand from a scientific. Are some of the guys winning over the headspace, or is it still in the early stages, so to speak?
So I myself, as you know, is a quant investor. I am a strong believer in using scientific methods to evaluate investment strategies. But at the same time, I try to keep an open mind. So I don't want to say that one method is better than the other method. I think you're right that the more scientific way of investing has basically made large inroads over the last 20 years. But at the same time, I think there is a role for it. And I personally have a great respect for some of the more discretionary traders that, when Chanos, for instance, is finding, funny things in the accounting numbers in a way that you can't really get a computer to do right now, or when other discretionary traders are doing things that cannot easily be codified in a computer because it's more relying on more soft information or different, case-by-case type of analysis. I personally have a great respect for that also. And so I'm not sure that will gravitate to everybody investing in one way. I think investing fundamentally will have many aspects, and it's driven by people having different methods and different points of view. And that's basically what creates a buyer and a seller, that there are all these different ways of doing it.
Let's talk about the role of hedge funds in the economy. The typical understanding, clearly not for those that know, but for the typical understanding, there's often negative press, especially at chaotic moments. And words like speculation will be thrown around in a really negative sort of way. But there is a role for hedge funds in the economy, and it's not just necessarily the investors themselves that invest in the particular fund. I mean, some people might say, "Hey, why should I be concerned with assorted hedge funds? I'm not invested in these." Or talk about, from a big picture standpoint, we could talk about this all day, the role of hedge funds in the economy.
Hedge fund can play a very positive role in the economy for a number of reasons. I think, first of all, our free market economy basically allocates resources based on prices. If somebody invents a drug that can cure a particular disease, he may not have enough capital to pursue that cure, but he can, this is a very promising idea that others can understand, he can then raise a lot of money through the capital markets and then build the factories to pursue that idea. Whereas another inventor who has a perhaps not very useful idea, he might have a difficult time raising money, and therefore the machines and the real capital, the factories are allocated to the more promising idea. Now that whole notion relies on market prices being relatively efficient. The company with the more promising ideas, their stock price has to be higher, their market cap has to be higher in order for them to be able to really raise more capital and build more machines. And so this is incredibly important for the market economy. And hedge funds and other active investors are tending to buy low and sell high, so they tend to push prices in the right direction, making markets more efficient. And again, that's just incredibly important. They help to provide liquidity, make it easier to buy and sell for investors, make it easier for people to save for retirement. A lot of large pension funds are invested in these types of vehicles, and hopefully hedge funds and other active investors contribute to their performance, although of course they take large fees and they keep a lot of the benefits for their own sake too. So I think certainly fair to say that investors should be very concerned about the fees and to what extent they themselves enjoy the benefits of those investment strategies.
You ask a question to David Harding in the book, and you ask the question essentially is, does your research suggest that it's better to have the same type of model for every instrument, or is it better to have a very specific model for each one? Why don't you talk about his response and your feelings about the response, your experience as well?
Yeah, so I agree with his response that it's very important to have a very robust model that works across a number of different securities. It's often tempting to really tailor your strategy so it looks like it's the best for every asset. You might want one particular managed future strategy for gold, another strategy for wheat, yet another strategy in commodities, and so on. If you try to do something like that, you might get an extremely good performance in your back test, in your simulation of what would have happened in the past, because you're able to tailor this. But you might be exploiting a lot of noise, a lot of randomness, and you might actually end up with a model that works less well going forward in the future when it really matters, when you're actually trading for live ammunition and when it's really important that your model works. So to avoid that kind of data mining or overfitting of your model, it's often better actually to have a simpler strategy, one that how do you get confidence that your strategy has a chance to work going forward? Well, if the same strategy has worked for gold, not just the last year, but not just last 10 years, perhaps the last 50 or 100 years, and if the same strategy has worked across all the commodities, and not just all the commodities, it's worked for a bunch of currencies, if it's worked for equity indices, if it's worked also in fixed income markets, then you start to get a lot of conviction that this strategy is not just randomness, it's not just a coincidence of the past that will not repeat itself in the future. Then you start to get some conviction that this type of trend following strategy or managed future strategy has a chance to actually work in the future as well.
You were a part of the AQR study, the Century of Evidence on Trend Following, yes?
That's right, yeah.
Was there anything in terms of going into that project? I mean, you obviously had ideas about how things might unfold. Were there any elements or insights going through that process, doing that research, doing that study that surprised you?
Well, it was a quite exciting project, actually, because we had been doing a lot of research on what are the best trend following strategies and showing that some relatively simple trend following strategies actually have performed extremely well over the last 20 to 30 years. And they've worked on average, not every year or every day, but on average for every instrument we looked at, which is sort of unusual. You sort of think that it's going to work perhaps at the portfolio level, but not necessarily for every instrument in the portfolio. But we found this very consistent performance even at the instrument level. So we were thinking about, wow, this looks really robust, but how can we get even more conviction? How can we get another out-of-sample study? Of course, one out-of-sample study is just waiting and looking at the live performance going forward. We didn't have the patience for that, so we said, well, let's actually go ahead and collect data, historical data on prices that are earlier than what we had looked at before. So rather than looking just over the last 20, 30 years, let's look at a full century of data. We were a little bit worried, of course, that what it seemed like such a robust result maybe, didn't work the 60 to 70 years prior. But to our surprise, it actually had worked really extremely well also historically, and about as well as in the more recent sample.
You mentioned in your book about the arms race and high frequency trading. I think there's an arms race amongst trend following managers to see how many centuries they can go back, right? I think you guys inspired with your first paper. I think several others have come right after, huh?
That's right, yeah.
One of the things in your conversation with George Soros, he talks about that you should not risk a significant part of your capital. Therefore, if you have a good run and you're making a lot of profit, you can risk your profits more than you can risk your capital. That's a very classic time series momentum trend following type thinking, a very quant thinking. Did you talk to Soros about the implementation of his strategies? Because, he has this very philosophical view. Did you talk to him about implementation at all?
Yeah, I think he has a different way of implementing it, not so quantitative, but he's also very concerned about, the downside risk versus upside risk. So what he's really hoping to find is a strategy or a bet that has a big upside potential and a limited downside potential, and then put on a lot of money into that bet, like he did on the British pound. And he talks about, he had the courage to really put such an enormous position on the British pound, because if the pound broke, he would make a lot of money. But given that it was trading in a band, there was almost no risk that it would make a large move going against him. And that type of thinking actually, he told me, inspired John Paulson in the way he sized his subprime bet. So I asked actually John Paulson whether it was true that he got the idea to size the bet he did the way he did from Soros, and he confirmed that in that interview. So that was sort of a fun back and forth.
Yeah, it's those kinds of guys. I think everyone has to look with deep admiration, because many of the traders that you talk about in your book would not have the latitude to take those kinds of bets. There's a certain discretionary element. I can use some interesting sports metaphors and some kind of randy language to describe it. But let's just say it takes a certain amount of gusto to do what those guys do in terms of their big bets, doesn't it?
It definitely does, yeah. And to keep riding at them when they've made a lot of money, to not just fold but be satisfied, but really just keep the bet on until it's really delivered its full potential.
Is there anything else that you would like to tell the audience about this work in particular? Like I said, throughout this conversation, people are just going to have to get it and read it. It's dense. There's a lot of different directions that you go. Is there anything in particular that you want people to understand before they read it?
I think definitely. I hope people will find it interesting if they would like this combination of interviews with what I view as the 8 of the best managers out there, combined with sort of the economic thinking that goes behind those strategies and a more thorough analysis of how would you actually pursue those strategies, and what does it tell us about how markets work and how efficient capital markets are.
Where's the best place that people can go to find out more about you and your firm? Clearly, the book is on Amazon right now. Where can they go?
I have a personal website, lhpedersen.com. AQR is obviously at aqr.com.
Appreciate your time today, sir.
Thank you.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.